how does timing, and in specific market timing, impact your valuation when you go to exit? The markets have been a little choppy lately, and so we can see that they certainly can have an impact in a hurry. But how much do they impact startup valuations? When you actually go to M&A, the answer, unfortunately, is a lot. And so let's just say that the stock market. I'm going to rewind a little bit here, but let's rewind to the Great Financial Crisis in that time frame. And so this is not an exact chart by any means, but the market was kind of going up into 2007, then it gets choppy, and then it crashes, and it wasn't a straight line, but it crashes in 2008 very, very sharply. The bounce back was actually relatively quick. But if we look at this, what we call max drawdown, so how big was the drop top to bottom, and how does that impact startup valuation? So a major crash like this, well, the S&P 500, so major US stocks, was something like minus 48% in the worst of it. So you round it and say minus 50. So almost half. And then you have the what's called the Russell 2000. So what is that? That is small cap stocks. And why do I bring this up? Why do I not bring up the NASDAQ? Well, because the answer is the NASDAQ actually was and is fairly similar in its risk characteristics to the S&P 500. In fact, these days they're almost the same because so much of the market cap of the S&P is actually big cap tech stocks that are in the NASDAQ. So the Russell 2000, so small cap stocks, these are still big by startup, from a startup comparison standpoint, mostly $1 billion plus valuations, but not past 10, 15, 20 billion. And so these, what are considered small cap stocks, they went down 60% roughly during the financial crisis. And so again, that notion of max drawdown. So it's still a big drop and even bigger than large stocks. Then you get into startups. So how much do startup valuations decline? And unfortunately, the numbers aren't pretty. When you're down here at the bottom, like if you were trying to sell a startup in 2009, good luck getting anything at all. Nobody wants to buy a startup in that time, in that sort of environment. Of course, some deals got done, but it's very difficult. Startups, it's going to be anywhere from minus 70. Believe it or not, it can go down as much as 90. So minus 70 to minus 90%. So as much as 1/10 the price, but maybe more reasonably 70, 75%, a 3/4 markdown from the top to the bottom. So what does that mean? Well, realistically, that means going from if 10x ARR is sort of the traditional target that a lot of folks use, you can see valuations go down to 2 to 3x ARR and even lower. They could go down to 2 to 3x, and they could go down to 1x in the really bad case. And so market timing matters. Hey, I certainly was a beneficiary of that when we sold in 2021, when we sold Hidden Levers, my last startup. We were hitting, very near the top of the market in terms of startup valuation. And so we prospered by that and were able to be above this kind of metric. But if you were to rewind just a few years, you would see those valuations coming down. If you fast forward to today, actually, markets are higher, meaning the major stock markets are higher, but at the same time, other factors like interest rates are not. They are much higher than they were back then, that zero interest rate era, and so that's driven some valuations down. So keep this in mind, that one of the largest factors that you can't control is actually valuations of equities as a whole, because hey, when you're selling a startup, you are selling stock. So you are compared to public stocks as well as larger private companies, and these valuations will vary widely. And so if 10x is the metric that everyone uses, it collapses when the market gets tough, and then it recovers, in the next cycle.